If I give you 1 million naira right now, what will you do with it? Will you spend it or would you invest it? Because the moment you discover the types of investment, you stop working for money. Money begins to work for you. Now, in the next 3 minutes, I want to explain to you the main investment opportunities that we have that can move you from where you are to where you want to be. So the first is stocks. Stocks, shares. When you buy stocks, you become a part owner of a company. When the register of the owners of the company is being called, your name will be on that list because you have bought shares of that company. So a shareholder is a part owner of that company. Though there's a difference between someone who has bought 99% of the shares of that company and you who bought small shares. So we have that's where we talk about those who have control, those who have influence, and those who have ordinary investment. So I don't know the class that you want to belong to, whether you want to have control, or whether you want to have influence, or whether you want to have an ordinary investment. But fact is that when you buy shares, you become a part owner of a company. Don't you love that? I'm sure you would. Now, let's talk about the risk and the reward. So when you buy shares, it has high risk. What is this risk? Let me explain it to you without sugarcoating it. In the event that the company fails, the money that you invested in buying shares, that money is likely to be lost when the company is being liquidated, either voluntarily or is being forced to liquidate. There is what we call a settlement process. During that settlement process, all the creditors, different groups, you have those ranking first, they will all be settled, second, third. The group of people who rank last are the shareholders, you, when you buy shares. So once they settle every other person, by the time they get to your turn, it's very likely that the funds are exhausted. So you may lose your investment. Sometimes after settling all those classes of people before you, there could be a surplus, a huge surplus. And when there's a huge surplus, you are the one to enjoy. But in all, I want you to know that when you buy shares, it has high risk. That is because there is a risk of you losing your investment if the company fails. What are the good sides? The good side is that you can gain from capital appreciation. As the market value of your shares can appreciate and you might decide to sell it, or even if you don't sell it, you know that you are richer. How does it happen? Let's assume that you bought shares at 1,000 naira and now it is worth 5,000 naira in 6 months. What does it mean? It means that per one share that you bought, if it's not selling at 5,000, it means you have made profit of 4,000. You may decide to sell and you have made a huge profit. That is one way. Another reward for buying shares, for buying stocks, is that you are paid dividend. Usually, dividends are paid like every year. When profit is made, the management may decide to say, okay, we are declaring profit and we're paying dividend to the shareholders, and they pay dividend. So it might be collecting dividend every year, but it is not compulsory that they will pay dividends every year. Sometimes dividends are not paid. Those who manage the company, who are actually your servants, they are your stewards. They may decide not to pay dividend because they have seen better prospects. Maybe they want to expand or they want to invest in other projects which will benefit you. So where this happens, you are still going to be happy about it. So basically, there is dividend payment and there's also appreciation in the value of your shares. That is for stocks. The next investment I want to talk about is bonds. Bonds are essentially loans. Bonds are loans. When you buy a bond, it means you have lent money either to the government or to a company. So bondholders are creditors. They are people who lent money to either the government or to a company that issued bonds. So in return, what do they get? They are paid interests. And also at the maturity period, they get their principal back in full, despite all the interest they collect. Some pay every month, some pay every 3 months, some pay every 6 months, depending on the agreement or the arrangement. So bonds are not as risky as this is because when the company liquidates and settlement is being done, bondholders rank early. They rank earlier than ordinary shares. They are settled. They are one of those people who are settled early. So you are not likely to lose your investment. Secondly, the reward is not as high as that of shares. They are paid interest, but the interest is not as high as what the other guys, shareholders, get. So that is another thing you might want to consider. So there's low risk, but there's stable income. Yes, and because of that, the returns are lower compared to stocks. Okay, next I want us to talk about real estate. Real estate, you know real estate. You can buy land, you can buy houses, and basically you can build houses or build property and rent them out. So this is another one, but it requires huge capital. It requires huge capital to invest. So what are the good side? The good side is that you can be enjoying rental income. Another one is that the value of your property can appreciate seriously, especially for land. We hardly see land depreciating. Land always appreciates. So when land appreciates, you can decide to sell. You bought the land for 50 million. It has appreciated to 100 million. You can sell and you smile to the bank. So that is for real estate. But don't forget that it also has the disadvantage. Sometimes it is not as rosy as the picture is painted. First, you need huge capital to invest in real estate. And secondly, you might be hoping to enjoy rental income and you run into some stubborn tenants and they don't want to pay. So that's one thing about real estate. Another one I want to talk about is mutual funds and ETFs. Mutual funds is where you buy, when you invest in mutual funds, you have experts who use your money to invest for you. It's in a pool of investment. They have a pool of investment and they invest in very, very good stocks and bonds and whatever. They know how to do very good investment and then they pay you an agreed percentage. ETF also is traded on the stock exchange and it's a mixture of bonds and shares and all that. So when you buy an ETF, an exchange trade, you could just buy one and then you have shares in 60 companies. It is like that. So it is a diversified basket of investment. It's a portfolio that is well balanced so that the risk is not too much protected. So it is recommended for beginners. If you are an investor who is just beginning, you don't want to take high risk, it is recommended that you go for mutual funds and ETFs. So because of the diversification. Diversification means you're not putting all your eggs in one basket. Your risk is spread so that it becomes very, very small. If you invest all your money in, let's say, one state in Nigeria, for instance, what if something happens? The government passes one law and then your investment is already at risk. But if you spread it into all the states, you see that the risk is well balanced. So that's what diversification is all about. So the next one is fixed deposit, savings. In investment, we say the higher the risk, the higher the returns. So when you put fixed deposit where you have an agreement, this is a percentage. Don't touch this money for this period. As you're saving it, they're paying you. It's the safest type. And when you deposit money in the bank for a fixed period and you earn interest on it. So that is what we call fixed deposit. So it has very low risk, as I said, and the return is also very, very low. So the higher the risk, the higher the returns. But it is not always so. Doesn't mean you should go and take very high risk, believing that you have high returns. No. The risk we're talking about is calculated risk. It's diversified risk, not any kind of risk. Not that you just go and invest and your money is gone. No, that's not what we're talking about. Then there's also alternative investment in this alternative investment like cryptocurrency, investing in gold, investing in oil, investing in some private businesses and all of that. So these are also what we call alternative investment. They are very, very risky, really. They're very risky. They have higher risk, but sometimes they have higher returns. So to summarize, I'll say that your best investment depends on your risk appetite Are you risk averse, or are you somebody that you are willing to take high risk because you want high returns? Some people, they are risk averse. They don't want risk at all. So you have to know the kind of investor you are. If you are the type that you lose money in the short run, you are likely to have very high blood pressure or even collapse, then you have to be very careful. Look for a well-diversified portfolio to invest in that has the lowest risk. You can do fixed deposit. Also, what are your financial goals? You need to identify your financial goals. Then your time horizon. Look at your time horizon. When are you expecting this money back? Sometimes, like if it's ordinary shares, it is it's long term. But if you are looking at recouping money in 6 months, that is not ordinary shares. No. So the type of your time horizon determines the kind of investment that you should undertake. So if you found this class helpful, I want you to like, I want you to share, and I want you to follow me and subscribe to my YouTube channel, because I do this every day. I teach financial literacy, I share investment tips, and most importantly, I teach accounting and finance. I teach IFRS standards. The very difficult subjects in accounting are made simple on this platform. So my name is Echela Okori. Have a great day ahead.